We live in a time unlike any other in history, when you can access information and asset classes that were unattainable for most. Like 40, 50 years ago, it was impossible to buy a section of the entire stock market without considerable wealth. Now, if you have a couple $100, you can get a broad diversification of your portfolio. Now, what am I talking about? ETFs, or exchange traded funds. I've spoken about this in a previous video, which you can check up above. So I won't go into the nitty gritty of ETFs. Rather, I want to look at how to choose winning ETFs based on your objectives, your risk appetite, and your current disposable resources. Now, before we jump in, if you're interested in this kind of thing, personal finance for entrepreneurs, affiliate marketing, and starting and growing your own online business, I highly recommend you subscribe to the channel and definitely like this video. Damage that like button for the YouTube algorithm. Now let's dive in. Now, the first thing you want to do when it comes to choosing a winning ETF that'll help you grow your net worth and retire in Maui or whatever the case may be is you want to understand what your specific goals are. Do you want to be a millionaire in 10 years? Do you want a slow burn, like if you're 20 years old today and when you retire in 45 years, do you want to have a huge nest egg that'll support you when times get tough? Or are you just dabbling in the stock market to see if it's something that you want to do with more energy and focus? Whatever the case may be, you want to choose ETFs that support those goals and not the other way around. Now, there are different types of ETF based on, of course, what you want to accomplish. First and foremost, you have the ETFs that cover basically the entire stock market or an indice of the stock market. For example, they may track the entire US stock market, the international stock market, or they may track the S&P 500. And these ETFs are the most stable when it comes to growth over time. After all, the S&P 500 has delivered 10% returns for about the last 100 years, and that's 7 to 8% above inflation in any given year. If that's what you're looking for, steady growth, long-term growth, total stock market ETFs are something that you should definitely look into. Now, if you're interested in more aggressive growth and a specific sector, then sector ETFs are what you're looking for. Now, there are 11 sectors in the stock market, and sector ETFs focus on each individual sector. You have information technology, you have agriculture, you have construction, you have finance, etc., etc. So sector ETFs are a basket or collection of stocks in that specific sector. So if you're really well versed in finance, but you don't feel you have the expertise to choose an individual stock, but you feel that finance is going to see an uptick based on certain factors, then you can buy a sector ETF and hedge your bets that way, and while diversifying your portfolio to an extent. And then again, you have bond ETFs. Like bond ETFs, they won't give you as high as a return, but they will produce a passive income every single month or every quarter, however the bonds are structured. Now, this is great if you already built a certain amount of wealth and you really just want to produce passive income, a couple $1,000 a month or whatever the case may be. Bond ETFs can do that for you. They're not as volatile as sector or stock market ETFs. And the good thing about bond ETFs is that there's no expiration date. Like if you were to buy a bond from the government or a corporation, there's a set expiration date. So if you buy a bond ETF, you can be sure of your dividends indefinitely. Now, after you've settled on your goals and the type of ETF you want to look into, it's time to shortlist candidates for inclusion in your portfolio. Now, you want to start with reputable ETF fund managers like Schwab or Vanguard, etc. These ones have long track records, and you be sure that your money is relatively safe. It's the stock market, so your money is never 100% safe. But you won't have to worry about the fund becoming illiquid or something along those lines, right? So make sure you focus on the traditional fund manager, or rather the reputable fund manager, so you won't have sleepless nights worrying about whether or not the fund is going to go out of business. So once you've done the preliminary work, you understand your goals, you've chosen the kind of ETF you want to invest in, and you've shortlisted possible fund managers, it's time to really start looking at individual ETFs. Now, I'm going to be using an example from Vanguard, the VOO. This is an S&P 500 ETF, and The reason why I like it is because it tracks the S&P 500 index, and the S&P 500 has produced 10% returns over the past 100 years. So if they have small tracking errors, I'll talk about tracking errors in a minute. If they have a small tracking error, then you can be more or less certain that you're going to get the same return as the S&P 500 as a whole. When it goes up, your value goes up. When it goes down, your value also goes down. So I'm going to jump on over to picture in picture and start showing you the VOO ETF while I'm explaining what to look out for. This is the page on Vanguard's website that you can take a look at all the information associated with the ETF. As I mentioned before, VOO is an S&P 500 ETF. The first thing you want to look at is the size of the fund. How much assets do they have under management? Now, this one has $573 billion under management, $573 billion worth of stocks inside of the fund. Now, you want to look at this because if an ETF doesn't have that many assets under management, there's a high likelihood that it won't survive very long because it shows a lack of interest in the fund and it won't be able to produce those returns that people are looking for. So if it closes down, you'll have a sale event and then you might be hit for capital gains taxes and nobody wants that. So you want to make sure that the fund you invest in has a couple $1 billion worth of assets under management. And then the next thing to look at are the top holdings of the fund, the breakdown of the sectors in which the fund is holding, assuming it's not a sector-specific ETF, as well as the percentage that each company is of the total fund. So in this VOO, the top holdings are Apple, Microsoft, Amazon, Alphabet, which is Google, Facebook, Berkshire Hathaway, Johnson & Johnson, Procter & Gamble, Visa, Nvidia. So these companies are steady companies that have shown growth over the last couple years and or decades. Now, the reason why you want to look at the top holdings is, are these companies poised to grow? Do these companies have room to grow? Have they been growing over the last couple years? Has it been steady growth year over year? Or has it been like jumps, fits, and starts over the course of that time frame? So it's really important to understand what companies they're holding and how much of each of those companies they hold. Now, these top 10 companies make up nearly 30% of the portfolio. So if these companies have a really good run, then the portfolio is going to go up. If these companies have a really poor run, then the portfolio is really going to go down because so much of the wealth of this fund or so much of the assets of this fund are concentrated in the top 10 holdings. When you're looking at an ETF, right, depending on the type of ETF you choose, right? So if you have the S&P 500, then the equity sector diversification is directly correlated with the S&P 500. Or if you have the entire US stock market, then that's maximum diversification. If you have kind of like an off-brand ETF or an ETF that kind of sort of follows an index, you want to look at the diversification of the sectors within that ETF, right? So you don't want to be overly exposed to, let me say, real estate, or you don't want to be overly exposed to finance within your ETF. So over here on the Vanguard page, but each ETF will have this breakdown. It shows you how much or the percentage of each holding within the fund. And you want to make sure that nothing is like close to 50% of the holdings, right? Unless, of course, it's a sector-specific ETF. But even within sectors, there's still breakdowns within those sectors. For example, the information technology ETF will still be broken down from software applications, communication technology, etc. So in this portfolio, they have consumer discretionary at 11.6%, healthcare at 14%, information technology, which is software technology, at almost 30%. So this portfolio is heavily skewed towards software companies or, technology companies. And this is a function of the S&P 500. The S&P 500 has mostly software companies. So another really important thing to look at is the past performance of these funds. Although past performance is not an indication of future performance, it's still really important to take a look at how it's done so far. So if to say you had invested $10,000 in the VOO S&P 500 10 years ago, today it would be worth $34,793. Now that's a 3.4x return on investment in 1 decade. And as you can see from here, since inception, it's averaged 14.13% return every single year. And 3-year return is 12.24. And then the 1-year return, this year's return is 15.82%. 0.09%. And then the blue is the actual ETF, and then the benchmark is this light gray color here. So you really want to pay attention to the returns. Are the returns something that you can stomach? There's a neat tool here on the Vanguard website that allows you to compare ETFs against themselves. So I'm just going to compare a different ETF that I've been invested in, which is actually an information technology ETF. And I really enjoy that ETF because I'm in the information technology space. I have a software company, Kylie. You should definitely check it out. Shameless plug. So anyways, if you would have invested in VGT, Information Technology ETF, 10 years ago, your return would be 5.6 times, which is really amazing when you think about it, right? 5x return within 10 years when you're dealing with the stock market, and the S&P 500 will be returning about 3.4 times. So that's a big difference there. Imagine if you have like $1 million. That's the difference between $3 million and $5 million over the course of a decade. Another thing you want to pay close attention to is the expense ratio and or the fees associated with the ETF. There is a management fee for every ETF, and this one is really, really low. It has an expense ratio of 0.03%. Generally speaking, Vanguard ETFs are cheap, right, when it comes to their fees, because the average expense ratio of a similar fund is 0.91%, which is close to 1%. And that really adds up over time. Over a decade, for $10,000, you only pay $71 if you invest in the Vanguard ETF. Whereas with another ETF, you'll pay just over $2,000. Now, that's a big difference, and it'll be eating into your returns. Now, another thing you really want to pay attention to is kind of the philosophy behind how they're investing. Yes, it might follow a benchmark, but what limits are there on what they can invest in and what they can invest in? Like, can a single stock comprise more than 10% of the fund? Or can they buy more than 20% of the outstanding shares in any given company? Things like that. And it's really important because once a fund has too much money or too much exposure on a certain stock, things get a little hairy, and the fund beholden to the whims of that stock. Even if the fund wants to divest, if they have too much of the outstanding shares of a company, then they'll actually impact the share price of that company. So that's a really quick breakdown of what you need to know before you invest in ETFs. If you follow the advice lined out in this video, then you'll make more informed decisions about the kind of ETFs that you want to invest in. So to quickly recap, you want to look at the total fund assets to make sure that it won't become dissolved in the near future. You want to look at the top holdings and how those top holdings are distributed. You also want to look at the equity sector diversification. Are they into agriculture, real estate, etc.? Is there overexposure in any particular sector? Things of that nature. And you want to look at past performance, not an indication of future performance, but it's the best benchmark that we have. Then you want to look at fees and or the expense ratio. This is how much they charge you to manage the fund on your behalf. And then you want to look at the philosophy of investment. Do they have restrictions about how they can buy shares, how much you can hold of an individual stock, etc., etc. So that's it for this video. Thanks for watching. Make sure you subscribe to the channel if you're interested in this kind of content. Like this video for the YouTube algorithm, and I'll see you in the next video.